I'm ranking every dividend stock I own, the entire $220,000 dividend side of my portfolio, from the winners like one with a 58% cash return and 129% price return, to the absolute dogs that have cut their dividends and seen the price plunge. Hey, Bowtie Nation, Joseph Hogue here, and you know I love me some dividend stocks. I've got dividend payers on 4 different stock platforms in 6 different accounts, from a regular taxable accounts to all my retirement accounts. All told, over $222,000 in 12 stocks. Today, I'm going to reveal the ones ranked from best to worst. I've dumped the data from each account into this spreadsheet and ranked them on total return since my first purchase. And that means these first few are going to be ugly, some that have cut their dividends even. But that doesn't necessarily mean they're bad investments. In fact, I think the first few of these stocks are going to end up being the highest returns. Each stock, I'll highlight why I bought it, if it's still a good investment, and whether you should invest or not. Before we start, though, understand that these are only the dividend stocks in my portfolio with yields above 3%. So there are others that I've talked about on the channel, like ConocoPhillips, ticker COP, that I also own, but with that paltry dividend yield, I really don't consider it much of a dividend stock anymore. First up here is Ford Motor Company, ticker F, and we can see the price has gone nowhere over the last 5 years. It is paying almost a 5% dividend yield. Started buying Ford back in April of 2022, last year, when it was coming down from that big EV run up in the shares. And you can see here, I've got 500 shares worth $14.16 cost basis each. So an average cost basis, just over $14 there. Collected $700 in dividends so far. That is the dividends collected since that initial purchase. Cash return of 10%. So even though the shares have fallen 16% from that cost basis there, collected 10% to offset that, means a total return of negative 6.1%, the worst stock in this. But with that, I want to point out something important here. I had to rank this list on something, and I think ranking it on that total return right now just hides some of the potential in some of these stocks, especially Ford. In fact, it's one of my favorite dividend stocks going forward on that return potential that I'm going to talk about. Ford has some amazing brand loyalty from both Gen X and millennials. We see in survey after survey, both generations there, even the boomers, feel very strongly about Ford, trust the products. The F-150 has been the best-selling car for 41 years, not just the truck. It's been the best-selling truck for like 50 years, but the best-selling car of all cars for 41 years. The truck is sold every 49 seconds last year. If we can get the kinks worked out of that F-150 Lightning, it's going to see some huge sales growth in that EV boom. Here on the analysis page in Yahoo Finance, we do see analyst expectations. We do see here the revenue estimate analyst expectations for a 9% sales growth, 9.9% sales growth this year. That is huge for a legacy car maker, and just over $2 per share. That means the stock is trading for just 6 times on a price to earnings basis. It pays a 5% dividend yield. So I continue to like shares of Ford Motor. I pick up more shares on a regular basis. A 5% dividend yield is hard to beat. Then you got the fact that even a fraction of that EV market will mean huge sales for this company and drive that stock price up again. Next up, shares of AT&T, ticker T, and you can see this stock has gone nowhere but down over the last 5 years. Dividend is now 7.5%. That is down from what it was last year before that dividend cut, but still a respectable dividend yield. You can see I started buying the stock in December of 2021 as they announced that spinoff of the Time Warner assets, really getting back to their telecom roots. I think that really put the emphasis on the business that they knew best and was going to be able to bring that business back to cash flow positive. You can see I've collected about $1,300 in dividends. I own about 600 shares at a $17.40 cost basis. That's about a 12.6% cash return. So owning the shares a little over a year here, 12.6% cash return, but an 18% price return, negative 18% price return. That means my total return on these shares is negative 5.7% so far. Now here, AT&T is another value play trading at just 6 times price to earnings. Okay, so analysts are expecting about $2.41 in earnings per share this year. That'd be about 6 times PE and paying that healthy dividend yield, 7.5%. It's been so unloved over the past year that I think it's a rebound potential, but bad news just continues to pile up. We can see here that the dividend was cut last year, so I think it's safe for at least a while. But what I want you to do, folks, here, especially with something like this, with Verizon, I know a lot of investors in Verizon, we look at the statement of cash flows. So important. You really do see an industry in trouble. Okay, pay attention to the difference here in operating cash flow and investing. You've got this operating cash flow here up on top. The investing cash flow is the amount of money the company needs to reinvest in the company. Part of that is capital expenditures, the bare minimum it needs to reinvest in the company to keep it going. And the difference in that is what's left over after paying those capital expenditures and the necessary investing. That needs to be enough to pay for the dividend and pay down debt. For AT&T, it's not too bad. If you expand this financing cash flow, you'll see these financing cash flows. You see the net issuance of debt. You see the common stock outstanding. So a negative here would mean they're buying back shares of stock. They're spending cash to buy back shares of stock. If it's positive, they're having to issue shares of stock to fund the company. Net issuance, payment of debt. Again, if it's negative here, they are paying off debt. If it's positive, they're having to issue debt. Okay, and then the cash dividends paid, this negative number, that's the amount of money they're paying to satisfy that dividend. This all needs to add up, folks. If you look at the difference between operating cash flow and investing cash flow, you take the difference there. So over the last 12 months, 32 million or $32 billion in operating cash flow minus about $25 billion in investing cash flow. That leaves them about $7 billion. If you look at what they needed just to pay the dividend, $9.8 billion just to pay the dividend. So they did not have enough money left over from their operating cash flow minus what they needed to reinvest in the company just to satisfy the dividend. What does that tell you, folks? That means AT&T is going to have to issue more debt or issue more shares to help pay for that dividend. For Verizon, it's even worse. Verizon has been continuously issuing more debt to pay that dividend, and it's something that is just not sustainable. So AT&T a little bit more sustainable here. That's why I continue to hold on the shares, but you have got to watch these cash flow metrics and how much debt these companies are putting on because it is not sustainable. It's what Warren Buffett found out in his worst investment by far in IBM. That company was continuously issuing more debt just to pay off the dividend and the share buyback program. It eventually ran into troubles and ended up being Warren Buffett's worst investment ever. So you can see AT&T has been a complete dog for my portfolio. And while I do like it over Verizon, the cash flow metrics a little bit better at AT&T, I wouldn't recommend it at this point over others on this list. So other dividend stocks on this list, even some of the ones that are deeper in the hole, like Ford. I have covered calls on my shares of AT&T now, lowering that cost basis and probably keep collecting that premium by selling the call options against it, collect more premium against that as well as the dividend, and eventually just have those shares called away from me. We're just getting started, but I do want to highlight a special offer on one of the sites I use for dividend research. I use the premium features on Seeking Alpha for research on all my stocks, but it's especially powerful for dividends. I can see yields, dividend growth, and safety. But really, the best of all these is in the estimates tab. I can see the estimates for how much the stock is going to pay in dividends over the next 2 years. It's a great way to plan out my cash flow from dividends. Use the link I'll leave in the description below to try out Seeking Alpha Premium Access risk-free for 7 days. If you like it, that link is also going to give you a special promo code for $50 off that premium access. Next up, Medical Properties Trust, ticker MPW, the largest owner of hospital real estate in the United States. Lots of news on this stock over the last year, especially as those interest rates have just really beaten the stock down. Now, this forward dividend yield is not correct. They recently cut the dividend to protect that cash flow. I'm going to be talking about that. They cut it to 15 cents a quarter, 60 cents a year. That is about an 8.2% dividend yield on this stock right now, which is still, even after that dividend cut, a very good yield. Here you can see I did start buying the stock back in October of last year, 2022. I've got 6,000 shares, just over 6,000 shares at a cost basis of $8.24. So I've collected about $5,200 in dividends. That is about a cash return of 10.6%. So again, even though the price has fallen 14% from my cost basis, I've still collected a 10% return. So the total return here is only 3.4% down. I still believe in Medical Properties Trust. I'm going to talk about why I believe this is going to be one of the best performing stocks in my dividend list. I just recently posted a video updating on MPW, so I'm going to post the link to that in the description. That's where I talked about 3 catalysts for this stock. Well, one of those catalysts is the September 13th deadline for the company to respond to the California regulator on its deal with Prospect Medical. This was a big part of the drop over the last couple of weeks. I do think that deal is going to go through. We saw a 13% hit to the shares when that deal was put on hold and could see a bounce back if it's approved. Now, the other catalysts here are longer term. Okay, the entire real estate sector was just slammed last year on the higher interest rates. The Fed raising interest rates the fastest pace in 40 years to hit the REIT sector, real estate investment trust, and real estate in general, just because real estate is so heavily leveraged. Anytime interest rates go up, that brings down property valuations. It pushes up the cost of owning that real estate, put a lot of real estate owners out of business. The REIT sector as a whole was down 25% last year, and it's down this year as well. So a lot of this pain in medical properties trust is not just medical properties. It is the entire real estate sector. The market still expects the Fed to be able to start cutting rates early next year, March, April of next year, and that's going to send valuations for all real estate stocks as well as real estate in general up higher. Okay, you're going to get that bounce back effect. That's going to support this stock. The third catalyst here, we need to see some kind of improvement in hospital operations. Over the last couple of years, hospitals have been in a real critical area as far as their operational and their cash flows. Okay, a lot of the pandemic pushed off a lot of those higher margin elective procedures that put hospitals in the red. Reimbursements from the government, from Medicare, Medicaid, and insurance companies have not kept up with inflation. So a lot of hospital operations. They're having to close down a lot of the rural areas because the operations have just not kept up and are in the red. We do need to start seeing some of that bounce back. That would take fears of the insolvency off of the two largest tenants here, Steward and Prospect Medical, off the table for MPW. That would help support the shares as well. Altogether, I think shares of MPW are worth $13 a share here, along with that 8.5% dividend yield you're getting right now, even after that cut. It's going to make it one of the best return stocks in my dividend list. I'm sticking with it and buying more regularly. Next up on my dividend list, gaming and leisure properties, ticker GLPI. It's another real estate investment trust, another real estate stock here on the list. This one owns casinos as well as leisure properties, so resorts. We can see here over the past 5 years, price just barely up there, but it is paying a very attractive 6% dividend yield. I've been buying the stock since August of 2021, a couple of years now. Don't have a big position, just 100 shares at a cost basis of $49.30. That is negative from where the price is now, about negative 6.5%, but I've collected 12% cash return. I've collected just over $600 in dividends since I started buying this stock. That means it's an overall positive return with cash and price return, positive return of 5.8% so far on gaming and leisure properties. Again, this company owns 52 properties across 17 states, many of them without a competitor for more than 60 miles. These casinos are operated by some of the biggest names like Caesars, Boyd, and Penn National, with gaming and over 15,000 hotel rooms. So now, besides the growth in gambling that we're just starting to see pick up here in the United States, I really like how the company's strategy is working here. It contracts with the operators of these casinos on a triple net basis. So triple net basis. So the casinos pay all the costs as well as maintenance. Strong contract terms here means that GLPI has been able to keep 100% occupancy since its inception. That is very rare for a real estate investment trust, for a real estate company to be able to have its properties 100% occupied. And it's because it's contracting with very strong casinos, and it's contracting under those triple net terms, very favorable terms to the casinos. They don't want to leave. Now, the pain here is one almost exclusively because of the overall real estate sector and the hit from rates. Okay, we're now in that attractive valuation and a very good dividend yield, 6% dividend yield, upside on the price due to when interest rates do start getting cut. These will do very well when those rates start coming down, and I'm going to continue to collect that dividend while I wait. Now, that said, if we look at that list, each of these first four stocks are a negative price return since buying them, and I'm in the red on three of them, even after accounting for that dividends. But I believe three of these four, excepting AT&T, could be some of my best returns in this dividend list. We're going to get right back to our list. I want to get your input on this as well. Which are the stocks in your portfolio that are in the red, that are down, but you're confident are going to rebound? Okay, let me know in the comments, which stocks are you holding for those higher returns that could surprise from where they are now. First bank on our dividend list, New York Community Bancorp, ticker NYCB. We'd see over the last 5 years, it's really rallied over the last year. Here, I'm going to talk about why that is. Paying a 5.5% dividend yield, not quite as high as it was at those lower prices, but still a very respectable dividend yield for a bank. You can see I started buying the stock back in June of 2021. I own 5,000 shares at about $11.50 cost basis. This is a fairly large position compared to some of these other dividend stocks. Collected just over $7,600 in dividends. That is a 13% dividend cash return there. Price return hasn't been high, 3.8%, but with that dividend return, collected a 17% total return so far. NYCB became a major player in regional banks with its Flagstar acquisition. That gave it 436 branches across the U.S. It's also the second largest multifamily lender in New York City. Got a sweetheart deal acquiring the Signature Bank of New York assets from the FDIC when that bank failed this spring. That is a big reason these shares have rallied since the banking crisis. It acquired a lot of those assets from SBNY that was taken over by the FDIC. Got a great deal from the FDIC for those, really broadened out its cash profile. Until then, until that sweetheart deal that it booked with the FDIC collecting those assets, there was a question about the cash flow and sustainability of the dividend, but that's all cleared up now. The stock reached multi-year highs just recently. I do think it's kind of tapped out here at fair value, right around $12 a share. It's going to struggle to go any higher than that, with that, especially with that high dividend paying out so much of those cash flows in the dividend. So I am selling covered calls against my position with that $12 strike price, collecting that extra cash yield. So I'm collecting the premium on those call options as well as the very strong dividends still here. If the shares do close above that $12 and get called away, I wouldn't buy it back in at this point. And if they don't, I'll just sell another call option at that $12 strike for more cash on top of the dividend. Next dividend stock here, the JP Morgan Equity Premium Income ETF. That's the ticker JEPI, one of those very popular income ETFs selling covered calls against its positions to produce that dividend income, paying a very nice 10.3% dividend yield here. You can see started buying the shares here in February 2021, a couple of years ago, 300 shares at a cost basis of just under $55 each, collected about $3,500 in dividends there. That is about a 21.7% cash return on my shares. Price return only 0.2%. It is positive. The shares have not gone anywhere over the last couple of 2 years, but that is a 21, almost a 22% total return when accounting for that cash return. And among these income ETFs, these high dividend yield ETFs, the JEPI is my favorite, and it's pretty easy to see why. We see here in a 2-year chart of the JEPI there in red. We've got the QYLD, the very popular dividend NASDAQ 100 income ETF QYLD there in green, the RYLD in purple, and then the XYLD in yellow. All four of these very popular income ETFs, very high dividend yields, 10 to 12, even 13% dividend yields on these. But you see that high dividend yield and that covered call strategy has destroyed the capital in these stocks. You can see over the last 2 years, at this point here, even the JEPI down 11%, but far outperforming on price even these other income ETFs. We've got the XYLD down 19% over that period, the QYLD down 24%, completely wiping out that dividend that you collect on that QYLD. And then here the RYLD down 30%. So even though the JEPI has lost 11% of its price over the last 2 years, you've collected enough dividends to make it a positive return on that stock. Now, folks, one thing you need to understand about these income ETFs, whether it's the JEPI, the QYLD, RYLD, any of these high dividend yield income ETFs, is that the dividends are taxed as regular income. Okay, it's a product of how they're running these funds with those covered call strategies and that income. They are taxed as income. It's not at that lower capital gains tax that you get from qualified dividends on other stocks. So you need to understand that if you hold any of these JEPI, any of these income ETFs, make sure it's in a retirement account so you're not having to pay taxes every year on that dividend income. I'm going to continue to hold the JEPI. I think it's a very well managed ETF. You get a little bit higher dividend yield, and you don't have to see your stock price fall apart like you do with some of these other stocks. Next up here, one of my favorite real estate stocks, WP Carey, ticker WPC. You can see over the 5-year period here, it is down a little bit. A lot of that is just on that massive sell-off in real estate stocks over the last year. Were it not for that, I think this stock would be much higher on the price. It is paying a 6.5% dividend yield. Again, higher than most real estate stocks. You're going to find 6.5% dividend yield. You can see I've owned this one longer than most of those others. October 2020, I started buying the shares, about 200 shares at $62.61 cost basis overall. Collected a little over $2,300 in dividends. That is about an 18.6% total cash return on my position. Price return just 3.8% here, so barely positive again after that really rough year real estate stocks have had over the last year. That still means total return on this stock about 22.4%. Not bad considering the sell-off in real estate stocks last year. I highlighted WPC as my favorite real estate stocks in a video last year because it really gives you the best diversification across property type, from industrial to warehouse, office, and retail space. Most real estate stocks you buy, most REITs, they only own one property type, so you just don't get that kind of diversification you get with WPC here. Now, most of the portfolio is in the US, though it does hold just over 35% of the properties in Europe, which gives it that great geographical diversification as well. Now, the company collects over $1.1 billion in annualized base rent and books 98% occupancy over 131 million square feet and more than 1,100 properties. So, again, a very large real estate company, geographically diversified, property type diversified. There's not a lot not to like here in WPC. Now, just being a real estate stock, and especially as an office owner, the shares have been hit hard, but the valuation is extremely attractive on this one. And again, I think the price should bounce back as we get closer to those lower interest rates. We can see here in the NAREIT data, the National Association of REITs, there's some great free data available that WBC now trading for around 12.9 times funds from operations. That funds from operations, the FFO, that's the measure you want to follow on real estate investment stocks. It is a true measure of the cash flow generated from operations, gives you a better sense than the PE ratio, gives you a better idea of the valuation as well as coverage ratio for the dividend. That is very low for this stock, which is traded closer to about 15 or 18 times FFO historically. So that 13 times price to FFO, price to funds from operations right now, very low compared to that historical average. I think you continue to collect that dividend as well as see price appreciation when real estate stocks do rebound. I know that is not a very popular opinion right now. Nobody wants to own real estate right now after the year it's had last year, but I still believe this could be one of the best performing asset classes over the next few years. Folks, if you go back to 2008, look at that last crash in real estate. Back there, real estate dropped something like 47% that year. If you look the next 5 years, 5 of the next 6 years, real estate was one of the top performing assets and the highest returns. I think we're going to see that again into the next couple of years as those interest rates start coming down and as the valuations start working back up on these real estate stocks. These next five stocks have all produced a 50% or more return for my portfolio. But first, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Digital Realty Trust, ticker DLR, is another real estate investment trust owner of data centers here in the US and internationally. You can see it's really rebounded from this March low around $98 a share, now at $132 a share, recovering a lot of what it lost over the last year just on that hype in AI demand and data center demand there. You can see it only pays a 3.7% dividend yield. Not very high, obviously not the highest on the list, but I do think there is a dividend increase soon in the future for this stock. I've owned the shares since May of 2018. I own about 100 shares at a cost basis of $103. That is a cash return of about 23% on the $2,379 I've collected on the shares over that period. Another 23.5% price return brings my total return of that stock up to 46.6, almost 47%. So very nearly 50% return on that stock over the last few years, cash and price return. And I know what you're thinking. Good God, another real estate stock. I've actually owned DLR for quite a while on that growth in data centers, and we're still seeing that strong growth of about 5% a year through 2027. Now, that is good growth compared to a lot of other property types. We do see that valuation on DLR has come down to about 17 times FFO, so a price of 17 times that funds from operations. That's well below the 20 times multiple or higher that it's usually at. And an FFO growth of 6 or 7% a year, that's going to keep taking this stock higher. Next dividend stock, Chevron Corporation, ticker CVX. You can see the chart here over the last 5 years since the pandemic, owned it over that period. And you see the boom here as those oil prices shot higher over $100 a barrel, made a lot of money on shares of Chevron as well as those dividends collected. It's kind of flatlined since last year, though, as the price of oil has stayed right around $85 a barrel. We do see that's paying 3.7% dividend yield. Not a bad dividend yield, not the highest on the list, obviously, but still not bad compared to a lot of other dividend stocks. We can see here started buying shares of Chevron in May 2021 here, just after the pandemic really hit oil prices and they started to rebound. Owned 200 shares there at $103.79 cost basis. collected just over $2,500 in dividends. That's a cash return of about 12.4%. So, not the highest cash return on the list here. It's a very low dividend yield, but the price return has been excellent on this. 54% price return on shares of Chevron. That takes my total return up to 66.4%. Now, the outlook for these energy stocks has changed. The upside on energy stocks isn't as strong, obviously, isn't as strong as it was just after the pandemic crash, but most of these explorers, these drillers, especially Chevron, has a cost of production of right around $45 a barrel. So, with oil at 75, $85 a barrel, these are still cash flow machines that are going to continue to pay out to investors. It's not a huge dividend, but it is consistent. Now, the only thing I would say about this, if you want to pick up shares, maybe wait for oil to fall back down to around 70 or $75 a barrel. That would be the lower end of the recent price range. I think you can pick up shares of these energy names at a discount at that point with that higher dividend yield and allow for more price appreciation in the future. Stag Industrial, ticker STAG. This is a dividend stock I've owned for quite a while. You can see the price action in this, not very much over the last 5 years, accounting for that sell off last year. Otherwise, it was up really nicely up through December of 2021 before the interest rates started going up and selling the real estate stocks off. Does produce a 4% dividend yield, a little bit higher on the dividend side for these real estate investment trusts. You can see here, started buying this one in November of 2016. I've got about 500 shares at a cost basis of $23.61, collected just under $5,000 in that time. So about $4,700 dividends collected. That's a 40% cash return. So not a high dividend yield, but you hold it for long enough and you're going to get a strong cash return on these shares. 55% price return over that period brings my total return to 95% over the period owning shares of Stag Industrial. I've actually owned shares of Stag Industrial longer than any other stock except one on this list. And I guess you can tell I've got a special place in my heart for real estate. I started my career as a commercial real estate analyst. It's always been a very strong performer at directly owning real estate properties as well as these real estate investment trusts. Always had a strong place in my portfolio. And I think it's great for cash flow as well as diversification across some of the other more volatile stocks that might be in your portfolio. Now, I started buying Stag on that increase in demand for warehouse and industrial properties. This is a major owner of warehouses, industrial properties across the United States, really in that shift to e commerce that's done very well over those years. In fact, demand is so good for the company's properties, those warehouses, industrial spaces, that it really hasn't seen that same drop in price that we see in a lot of these other real estate stocks on the list. Shares are up 16% since last November, even while they're down a little bit from the 2021 peak. Now, like a lot of the real estate stocks in this list, with the exception of MPW, which I think has a very high price return potential to its fair value, Stag isn't going to make you rich. A lot of these real estate stocks aren't going to make you rich like the tech stocks or some of those other stocks, but long-term steady cash flow is what you're looking at here. This is going to put your money in your pocket consistently with those dividends. It does have a high, consistent price return as well. You're going to make money on these real estate stocks year over year. Now, these next two dividend stocks I've owned longer than any on the list, and they are core to my portfolio. The problem is they only pay dividends every quarter, every 3 months, and your bills just won't wait that long. That's why I put together this video, the 4 monthly dividend stocks that will put money in your pocket every single week. Check that out, and you'll never have to worry about money to pay the bills. My favorite dividend ETF here for a lot of reasons, the Schwab Dividend Equity ETF, ticker SCHD. You can see a consistent price performer over the last 5 years, pays a 3.4% dividend yield. I've owned these shares longer than any other on the list. April 2014 here, cost basis of $37.52 on 400 shares. That's about $6,300 in dividends collected, a cash return of 42% just on those dividends alone. Price return over that period, 96%. That means total return over 100%, 138% total return, price and cash return on this stock, ticker SCHD. And I've held that Schwab Dividend ETF longer than any other stock on this list because it's a great overall dividend fund. Not only is as a fund, it's safer than individual stocks. It owns so many dividend stocks. You don't have to worry about one stock ruining your portfolio, but it still pays a solid yield as well. And the price appreciation, better than a lot of the individual stocks I own. The Schwab ETF holds shares in 100 of the highest dividend payers within that large cap US market and includes a lot of the faster growth tech sector as well. Tech makes up 20% of the fund, giving it that return plus that higher dividend yield. The fund covers all its bases, Coke and Pepsi, but also some dividend stocks you might not see in other portfolios, like these tech stocks like Cisco Systems and Broadcom. It's going to give it the price growth that you see, plus the higher dividend yield from these other stocks. My top performing dividend stock is another ETF, the Alerian MLP ETF, ticker AMLP here. You can see it hasn't done much over the last 5 years as far as price return, but does provide a 7.5% dividend yield. You see the whole list here, but I've owned shares of AMLP since March 2020, just after that big pandemic crash in oil prices. So a lot of price return on that as those shares hit that low. You see, I've got about 300 shares at a $17.85 cost basis. I've collected just over $3,000 in dividends. That is a 58% cash return on those very strong dividend stock. The price return, 130%, brings my total return to 180%, 88% on this stock. Very strong, both price and cash return on this one. So I bought the AMLP for a couple of reasons, only one of which really stands right now. Okay, first is that oil crash after the pandemic. I was loading up on oil stocks, did very well over that period. Also, though, I figured with the new administration here starting in 2020, that new administration coming in Washington, be slow to approve those pipeline projects. We did see that that would drive up the fees for existing pipelines, and that dynamic is still playing out. Okay, from Keystone to Mountain Valley Pipeline, a lot of these pipeline owners had to go to court to get their projects back on progress. These assets have gotten no love from Washington, from the government, but we still need to get that oil from point A to point B. So those MLPs have done very well on those higher fees. It's still a solid dividend yield, and you don't get that hassle of the K1 tax form that you get from individual MLPs. So, I love those MLP companies. You have to deal with the K1 tax form if you own those, but you avoid that with this AMLP, and you get a very strong price return as well as a dividend yield. Use the link below. Try Seeking Alpha Premium for a week free and get that special promo code for $50 off. Or click on the video to the right for the 4 dividend stocks that will pay you every single week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.